Welcome to our show live. There it is.
There we go. Okay.
All right. While I was having technical difficulties, I wanted to show you guys my my purchase from Jalisco. Thought you might get a kick out of it. Ben is Ben alive down there? All I've seen is the top of his head since he
Can't see me?
Since I signed on. I can see you now. Just wanted to make sure you weren't frozen. How's Ben's audio? Sounds kind of weak.
Can you hear me?
Yeah, it just sounds kind of weak.
That's all I got.
That's all you got? Talk louder.
I can talk louder.
Talk louder. Shouldn't be a problem for Ben.
Wake up everybody in that house.
Yeah.
Is there a volume setting on your thing?
Yeah, there's the volume setting.
Do you know how to use it?
I pressed up. I can hear you louder now.
Yeah, that's not a level. That's not a level. That's just a.
I don't think they have a microphone.
You got to get that fancy mic that David has.
There is actually a fancy mic right over here somewhere. Where is that?
Jen told me which one to get, so I did.
Yeah, and it works.
Yet another non-reimbursable expense, possibly.
Oh, the joys of being a business owner, David. All right, you want to see?
Holy moly.
Yes, that's amazing.
Isn't that beauty?
I love that.
Holy
You
moly.
cannot walk around Halos Toticlan without this, a pair of jeans, and cowboy boots. If you do, you will look like a complete fool. So for anyone who goes for the Festival of the Virgin Mary, do not go without jeans, cowboy boots, and a cowboy hat.
Do you also have to get those bandoliers? You know, the things that go, the cartridges that go across the chest.
That's probably a little much. You might stand out, but the white dudes in shorts and flip flops and t-shirts kind of stick out. So I stick out enough because I'm 6'4" and white as can be. But anyway, I did my best to blend in. Okay, yes. Share some talent. Let's get this. Everybody's retweeted and liked and all that good stuff. Welcome to Wall Street Beats, everyone. Today is Wednesday, August 13th, 2025, and we got a market that is on fire. Just short squeeze does not stop. So if you're long, you're loving it. So enjoy the ride while it lasts. And we got Besson out this morning, Ben, talking about 50 basis point cut now. Let's pour some gasoline on this thing, huh?
Yeah, you know, it's funny. He basically was publicly saying the opposite a year ago, like giving the Fed a hard time for, oh, you're gonna cut 50, and now that he's in the seat, he's like, well, we should cut 50. You know, the whole thing. So gross. It's like, it's so politicized now, like to the extent, I mean, it always kind of has been, but like, I think it's the worst I can remember it. I mean, oof. And this is what you get. You get green dildos all over the screen, baby. To use the WNBA thing that's going on.
Yeah, it's
but no, it's the market is anticipating Fed cuts. The SOFRs are up. The market is clearly up all over the place. I mean, there's a few stocks that are red today, but not many. You got to look hard to find them.
Yeah, that was what the tape looked. That was kind of what my tape looked like yesterday as well. Big green day.
Yeah, I mean, you know, it's like basically you look all over the place and it's like, oh, that's up. I mean, our Rocket mortgage is ripping. We got a 19 handle there now. I don't know. It's just, you think about like the fact is they're going to just try and take all the risk premium out of everywhere they can, which kind of gets me to yesterday. If we want to see a really good looking chart, pull up the weekly or the daily Alibaba chart. So I added a bunch of call spreads, 125, 150 call spreads yesterday on the Alibaba. But that's a good looking chart. And, I just kind of feel as though China is probably the laggard of all this. I mean, every market, Europe, US, volatility is getting sucked out. Yields are going down. It's like they're just coming for all forms of yield and risk premium all over the place. And so, you know what? Let's look. But there's some good looking charts out there. The housing rate sensitive related stuff has not been very good. So it's not even just Rocket and UWMC, the mortgage guys. It's the housing stocks. The XHB yesterday was up 3.5%. So, and the IWM, I don't even remember the last time we had 4 or 5% in 24 hours on the IWM. So yeah, I have to go ahead. I was going to say, I just think that there's got to be a lot of short covering there, because that has been a very popular funding currency. Short the IWM and buy whatever. So
well, and David has been all over this kind of China trade idea, and I don't know if you saw that report he did with that MIT professor. Which David, at some point during the show, I'd like you to tease that a little bit so people know about it and know where to get it. Because it's been very well received, and there is a ton of good information and good ideas in there. So why don't you give us your thoughts on what was the thinking behind putting that together, and kind of give us some high points without giving away the farm.
Yeah. So pretty simply, I was thinking about, I've seen a lot of deals in pharma with Chinese drug companies, and over the last I used to work for a Chinese brokerage firm, and I did a big report, a couple 100-page report then on what was going to happen in the Chinese market. And the idea is that as GDP increases, as countries get wealthier, they spend more on healthcare. It's an almost perfect correlation. And so that industry would develop. And in the last year or two, there have been a lot of deals where mostly U.S., Chinese citizens who came to the U.S., studied, go back to China, and they build what they know. So they've taken a lot of their expertise that they've learned here, and the ecosystem's developing really well there. The government's supporting the industry, the biotech industry. And so they're going from copycats to coming up with their own drugs. So pharma, which is very good at marketing, somewhat good at inventing drugs, is always on the lookout for new innovative drugs. So they start to in-license these and start to get pretty big money. Now, some of the Chinese companies, they're deciding to hold on to the domestic rights and just out-license the U.S. So it's pretty interesting. There's a Chinese billionaire who came out just from an IPO of a healthcare company. So it's really becoming much more entrepreneurial than it was. So I decided, okay, I want to find out what are the next drugs, and knowing that I'm not a PhD scientist, and I can look at them, I can wade through some of this and be pretty good at it. I decided to find someone who would actually be even better at it, at identifying what the compounds that are most interesting. And so this MIT, Harvard PhD candidate, he runs a lab at MIT. He and I worked on this for a few months trying to figure out which ones. And so I came up with a list of, or we came up with a list of 17 of the most promising drugs and the companies. Now, what am I going to do with this, or what are people who've purchased the report going to do with this? It's pretty simple. I'm going to look at each of the companies and say, I'm going to buy an equal weight amount of each stock. Small portfolio, just as a placeholder, hey, listen, this one of these is going to turn into a giant company. Several might turn into pretty good companies, and some might fail. But it's kind of a VC approach to a really interesting area. I want exposure, but I don't want to bet the farm on any one drug. Now,
so how do you do that, David? Is it like you put take a 5% of your portfolio and you allocate it among 10 companies, or?
Yeah, exactly that. You look at, and some are only public. Some are public on the Shanghai exchange, which U.S. investors really don't have great exposure to for individual stocks. Right. But if they're on the Hong Kong exchange, then it's pretty simple. You just take now this isn't for everybody, right? For me, I can say, let's take a certain percentage amount and divide it up equally and buy those stocks. Fidelity via, E-Trade, Interactive Brokers, very easy to do.
Yep.
And then every year or so, I might rebalance it, but I'm probably not going to. I'm probably just going to keep an eye on it for the next, and have a mindset that this is 3 to 5 years. This isn't, hey, I want to beat the market this year. It might. I mean, it's a really hot area, but that's how I'm thinking about it.
Okay, so this is more longer term hold, not really catalyst driven, not as in the weeds as you are with some of the U.S. stocks you have in your portfolio.
The report mentions each of the drugs that's interesting and like what the next data point is. So you can, if you wanted to look at it as, well, it's going to have phase 3 data at the end of this year or early next year. So you could track it that way.
Yep.
Now that's how I'm using it. So that's how it came about. I just did it for myself. And then I said, you know what, let's polish this up and let's get the
make it available for people. Yeah.
Yeah. And I got the perspective of the president of Merck, who runs everything outside of the US. He runs Joe Romanelli. He took a look at it and also gave his comments on how the market's developing. So the folks that are investors, that's one way to use it. Other people who already bought the report, there are hedge funds who are going to use it the same exact way. But for example, a large drug company could use it for targeting what drugs do they want to in-license, so business development wise.
Sure.
And then separately, I do know that capital markets folks and bankers will use it to, hey, which are the companies I should go after that are not? Yeah, exactly.
Okay, so are you gonna update this like in 6 months or every year, or how do you kind of look at the following through on this for people?
Yeah, that's what I plan to do, is kind of periodically just kind of go through each of the names. What's been the update? Is there, because sometimes there's a reason, even if it's you're doing this balanced approach where you say there's no reason for me to hold it anymore. This is not going to work out.
Right. Okay, good. Well, thanks for where do you get it? Let's do that. Let's do the plug real quick and then we'll get on with the rest of the show.
Yeah, so if you go to passes.com/Wall Street Beats and then you look under shop. So where in our area, you'll see there's the report name is there, and you can order it there.
Okay. And we've got a link. I'm sure we've got a link on it through our Twitter and maybe on our website. Okay.
Yeah, and I'll send it out again today.
Okay, cool. All right, so what else are you guys looking at today? Ben, I saw you mentioned Rocket already and UWMC ripping. Keeping those on, not touching those. Are you gonna go even deeper down the chain into that better mortgage you were talking about a year ago? Are you gonna reach a little further into your pocket with some more speculative plays?
You could do that. Well, I think the Rocket is going to be your market leader in that space. And then UWMC, I think I talked about on the show. I definitely talked about it with you.
Yep.
The CEO, the reason I got in there was because the CEO has doing one of those planned stock sales, 10.5B or whatever it is.
10B5, yep.
Yeah, and so he was like 16 or 20% of the volume. So he's kind of just stepping on it. But then they just had a great quarter last week, and they said that basically the best quarter since 21. And just another anecdote, I have a buddy who's a wealth manager at Morgan Stanley, and he's telling me he's starting to have his high net worth clients inquire about mortgages too. And, the truth is, with the curve the way it is, with the bottom, the 2-year, 1 year, like now the policy rates kind of coming in, well, then you could start getting in the floaters. Before when you had the short end leading and you had an inverted curve, you don't go into a floater. But now you're like, hey, I'll go on a floater. So,
sure.
You don't even really need the back of the curve, like the fixed I think it helps, but you can just go into floating rate mortgages and it's already sub 6 right now, which is a key number. And then that will probably hit sub 5 before a 30-year fix would. But, so yeah, the guy's selling. I like that. It's up 20% in the last week or so. Rocket's up like 40 in the last 2 weeks. So, if you.
So do you hedge them? You just keep riding them?
Well, I have a ratio call spread on the Rockets. So right now I have which means I'm short the 17 calls, and I used all that money to buy 2.3 times as many $20 calls. So no, I actually have not really done anything. But the question is like, maybe sell some calls at 25 or 24. I could look at that and, okay.
Right. Lock some in.
Extract some there that if we do, God forbid, stocks go down for a day. Although I was looking to see what it was. NVIDIA's actually down today. So,
Oh my.
The big
it's unheard of.
And my JP Morgan. I've written calls against JP Morgan, 295 strikes. Because it just, listen to our buddy Charlie and a few other guys, it's very expensive, and lower vol, lower yields, some curve flattening are bad for banks. And look, it has done nothing. I mean, this has been like a huge move up here the last couple of days. And I'm also did the same with the Wells Fargo. That's down today, JP. So the banks, I think, are in an okay place to be in the game of shorting or funding. I think IWM is now been taken off your menu for a minute because of the rate sensitive thing. If you look, I don't have the chart with me, but the rate sensitivity of the IWM companies is materially higher, and their debt refi beta, if you will, is much higher as well. So lower rates is going to help the IWM, and it's going to be bad. I talked about this a year ago, whereas lower rates is bad for the top of the market, and people don't think like that. But if you remember, just to go back 2020, 2021, everybody who had wealth, had a house, refied their debt. And that's their biggest, liability at the household level. But then also the companies, Apple and all these guys, they refied out and they termed it out. And then so rising rates was actually beneficial to their earnings. And so they became positive spread versus their liability. They were the bank in essence.
Yeah, I think that's a big misnomer too. When the Fed starts cutting, I think everybody thinks that the stocks just go up and up and up after that starts to happen. And actually, I think the initial move, if you look at the back test, the initial move is higher, but then stocks start to fade.
Yeah, I mean, look, I have a chart and I can tweet it out, but if you just compare the 1 year forward rate, so the 1 year rate, 1 year forward that's implied, the difference between the 2 year and the 1 year rate. Yeah. And you line that up with stocks, like just the S&P 500, they follow each other pretty closely. And so, yeah, initially, you get a little excitement. People are like, oh, because they have all this old, economist model in their head. They're like, oh, lower discount rates. And they never think about all these mechanics of how it actually works. Yeah. And why are rates going down? Well, it's because growth expectations are going down. How are stocks priced based on growth expectations, right? So, I mean, truth is, high rates are when you get high stocks. If you go back to the last tech boom, we had in the beginning of 2000, 6.5% rates. It's just kind of one of these things that just not as well. And this time it's actually bigger because of the thing I'm talking about with the term spread. And I went through all the S&P 500 companies. It's going to be a headwind to them, and to stay on the on the topic of refining, so they're a long ways down to that mattering. So they're going to take the brunt of having the T-bill and chill strategy at 5.25. Now it's 4.25. Well, soon it could be 2.25, and that's 300 basis points on huge cash piles. That I mean, Palantir, I think half their earnings are just T-bill income. And that's what's driving the stock. Right. But I think that's one thing. I like the idea also of starting to get long some volatility right here today, because I mean, all you look around and it's like people are getting beaten over the head, and vol's gotten completely sucked out. Well, OPEX is on Friday, options expiration for the month. And then this is also a weird month where the VIX expiration is next Wednesday versus it's normally the Wednesday before, because it's the third Wednesday. So this is one of those months where the third Friday is before the third Wednesday. And so we're just in, if you look at the volatility curve for equity, it's in mega contango. So it's like 16 sub 16, and then the next month's like 19. So there's a huge jump, and then that resets next Wednesday and on Friday. So I don't know. I would guess that this is the final bonanza of craziness right now. And we saw that in if you go back to, let's go back to like 07, where that rate cycle got going. Well, they cut, and then you had like one last little hurrah of stocks going up, rallying, and then that was it, you know. And so we'll see what happens, you know.
So what are you looking for, Ben, to know, to get a little more confidence that this thing is done? Like this rally in equity markets is pretty much done. Is there two or three things that you
let's like, I think I like the rate sensitive stuff, right? I think that we can have the situation where the market itself, like look at today, right? Like if let's see where Nvidia is right now. I mean, if Nvidia's down and the top of the market's down, I mean, you need so much action from the IWMs of the world to offset that, because it's so big.
Yeah.
Like just in terms of gross dollar, market cap dollars. So you could have like the top of the market get stalled out. I mean, Costco's down today also. You have the top of the market get stalled out, and then the rockets and the home builders and the restoration hardwares and those things of the world actually do well, and it kind of the big boy convergence trade that every value guy in the world has been getting killed on for
praying for, right?
Years. You could see that actually work. And so I personally look at the curve a lot of what the curve's looking like and what it's doing, and then how that translates then into what's going on. And so again, like, I kind of think that if the banks are in a little bit of trouble, then eventually that will permeate through. But in the meantime, I'm not like saying, oh, go short the market, but you could buy some vol when it's like really cheap, as like a starting point, and then just ride your green wave that we're on, and just, well, I'll tell you what.
But a 19 handle on September doesn't sound so cheap.
I have to look exactly what it is, but like, I'm just saying that credit spreads are really near the tights. The front of the curve for equity is, equities fall is coming a ton. Rates fall is imploding. That's one of the big drivers of mortgage spreads. I think the MOVE index is sub 80 now. And so again, they just come for all that to, eat it. Like, the way I would think about it, which is a good mental model for people, we have anywhere from 700 to 900 trillion dollars of capital in the world, right? And vanilla capital, not derivatives. And if you're a saver, you're like, okay, well, I want 4 or 5% on my money. I think that's the reasonable expectation. I know here at Wall Street Beats, we want to offer a little better than 4 or 5, but let's just say on a global scale, 4 or 5. Well, 4 or 5, that's 28 to 36 trillion dollars of income or gains that needs to come from somewhere in order to service that capital at the valuations they're at. And that's, let's be clear, 105 trillion of global GDP. You're talking about 30% of global GDP to just like feed the beast, if you will,
right,
at the current valuation. So, they come everywhere they can. They'll suck out the vol, they'll suck out the rates, and they'll suck out the risk premiums, which means higher assets. And we're seeing that. I mean, valuations are really high. So yields are probably the last like area that can, feed the beast. Like, look at Chinese yields as an example. China has minimal growth prospects, and it's been deflationary for years now, right? We're like year 3 of Evergrande was like May 21. So we're 4 years into that debacle of their real estate market imploding. They're 30 years like 1.7. The European, the Swiss bank, it took it to 0. So their rates are already at 0. It won't be long. The ECB will be back in the game. Like, I think that's the trend. So the question really is, how long does it last? And then that's when you actually are at risk. That's the real risk, is when that's all sucked out. Well, then there's nowhere to go. You know what I mean? So the question is, how long can this trend continue? And I think me and you, Steve, would agree, like, some of these things can go farther than you think they can.
Always. Always. If you live through 1999 through 2000, you definitely know that to be true.
And actually, let me just finish, and then I'll let David go, is just two housekeeping items. As a guy who does a lot of macro and doesn't do as much small caps as I used to, I got a good reminder. Small caps are not for the timid. I had been long Goodyear tire, and I had recommended it on the show. And let's just say it had a rough quarter. And
you definitely got punched in the nose on that one.
Yeah, it's good. Every once in a while,
few of us did.
You gotta get punched. You know, it's like Mike Tyson.
So you don't bat 1,000, Ben? Come on.
Until you get punched in the face. And the takeaway there was basically that the global auto situation is not good. And the day before that, Crocs kind of told you the same thing. Like, I think if any management team is telling you with confidence, they know exactly what their margins are going to be, how this is going to play out, I think they're not being the most,
Yeah, they're not being truthful or sincere.
Yeah, because like on that call with Goodyear, and this is why I was like, oh, I didn't like sell it because it was down. It was just like they had no plan. They didn't know. They're like, we're not even going to try and give you optimism of when this can stabilize or turn. They didn't know. And these guys are in the game, and this is a 100-plus-year-old company with Elliott's their sponsor. I mean, like, they did everything right internally they could, and that's what I think is probably the most disheartening for people is when a company divests assets and refis their debt, and
there's only so much in their control.
Yeah, exactly. Like when you do everything that's in your control, and it still is like, oh, well, our operating margins went from 8.9 to 5.3. I mean. It's kind of eye-opening. And then, the last thing I'll say is Weight Watchers, which we talked about, the three of us, which I do like still, but they printed, and this will be just one little takeaway, is they had earnings on Monday morning, first earnings post, the reorg, relisting, if you will. And stock was up 12% in the pre-market. It was in line. It was pretty good. And again, I was actually surprised. Morgan Stanley's covering this now, which they must have the term debt. Like, I can't understand what other reason why Morgan Stanley would cover a $400 million stock. So anyway, there's an initiation report of that. But so it opens up, and then remember, post-reorg equities, the guys who own most of the stock are the former high-yield guys who've had their high-yield bonds converted to equity, and they're not equity guys. Right. So they don't get benefited.
So they saw some liquidity and they jumped all over it.
And I talked to a guy who was one of our subscribers here at Wall Street Beats, and he's a high yield manager. And we were talking about it. He owns a little term, and he's like, we used to have a rule that it was like 90 days until we started like hitting it. And he's like, they're unnatural holders. So what we have to go through here is a shareholder transition. Kind of like when a stock goes from being a growth stock to a value stock, you need to turn the shareholder base over, and it's a bit, it can be messy. And so, like,
it's going to take a couple quarters
all day on Monday, and it goes from up 12% to down 13%, and in just one little TWAP, and then traded 1.3 million shares on a 10 million share base. They're the only guys who had the stock to sell that. So. I know a couple of people were like, that's an eye-opening move, right? And they're like, oh, what's wrong? And I'm just like, look, the numbers are okay. I mean, it wasn't great, but
I bought a little more. I bought a little more yesterday. So
yeah, and that's what I was going to say is I think that is a stock that I would actually buy. And so the price action there. So there's two examples, right?
Goodyear you got out of. Goodyear
I got out of, and it was
bad
down,
trade. I'm out.
25%, 20% from where I got involved. So that was proper ding. And then this one, it's like I think my average is like 32 or 33, but I was super early on that. Like I'm like 2 days after the relisting. Like most people, I start talking about it here on 38. So let's just use that number, 38 into 32, 33. Well, if it's just mechanical, I like buying it just because these market mechanics versus business is awful. Like, and that's a nice segue to let David talk about GLP-1s and our favorite stock, Hims, and like
not again.
Hims is down some, so and Novo and Lilly have not necessarily been great either. So
that Lilly stock,
GLP-1s. I'll let our resident expert come in.
Actually,
a little bit of hope.
Look, I'm there with you on the Weight Watchers. My average is 32, so I'm down 14%. But I agree, the way you positioned it originally wasn't, look, this is, Disney with 40 people covering it, and we're going to try to come up with the exact price target. It's, hey, this is completely misunderstood. You're looking at a multiple, several years from now if it works out. So yeah, we're not holding you to the down 14%, although I do have to mention it. um, so look, yeah, Lilly and Novo still down, but they're starting to find a base. Like I said, I wanted to be under 700, and so I'm well below on Lilly. Um, starting to get interesting. It's such a changing market. I just don't know there's a reason to rush in, and the president's still against against pharma, so you can be patient. You might miss a couple percentage points, but I don't think you're going to miss that 20% move that you're really looking for. Um, it's it's interesting. So what I've been trying to find, because the market's up so much, is, and we're all trying to find like kind of uncorrelated alpha. And so I've been looking internationally a lot more lately. Japan had an amazing night overnight last night. One of my stocks there, Astellas, which is a large drug company, was up 11% on some good data, but the market itself was up a couple percentage points. Um, so I spent the last 2 days trying to figure out, if oil prices drop, how much does Japan benefit and how much do Japanese stocks benefit? So this is right up Ben's alley, because I'm sure he's studied this before. But after a day or two of looking at correlations and the rest, it appears that a drop in oil might have a short-term benefit to Japanese stocks, but it's not like it's not a great trade. But I'm still interested in it. So I did build a little mini portfolio of Japanese domestic focused companies, like consumer staples companies or packaged good companies. I haven't pulled the trigger on it yet. I'm still working through it, so I'll send it around to you two and see what you think. But I'm interested in knowing if you think that's just a ridiculous thesis of, what, at some point this war ends, at some point Russia gets back on the market, you have lower oil prices, Japan's takes all their oil imported, and you know what, the US market's more expensive than the Japanese market, so being there might not be so bad. Now, the growth is on the companies that I've come up with is, you had mentioned Chinese growth being slow, Ben. That's kind of like what you see in Japan with a lot of these companies too. So interested in your thoughts on that. Is it worth my spending another day or two on this, or should I just move on and stick with the Amphastars of the world? I'm always reminded, when I was at Balyasny, it was a much smaller firm, so I got to work with Dimitri, and he said a lot of smart things that I remember. But one in particular was, smart people get bored and try to find ways to get themselves into trouble, and they look for
So true.
they look for like the third
attest to that.
yeah, they look for like the third derivative
Right.
trade, rather than what's the easy trade. And so I'm wondering if that's what this experiment the last 2 days was. But interested in both of your thoughts.
Yeah, I mean, so to answer your question, I actually have studied. I have like a workbook where it shows, it's like a macro workbook, and then it has one of the things, what percentage of oil they import and what percentage of natural gas they import, and then their mix of the energy. So yeah, it is a big deal for them. It's going to be a big deal for certain companies, not others, right? Like your energy intensity of your businesses. But with Japan, it all starts and ends with the yen. So you might want to look like at yen, oil priced in yen, right? Not oil priced in dollars. Even though they buy in dollars, you got to think about the price in yen. So when, I guess last year I talked about the yen in here a lot, but like yen's had a bit of a rough period here, right? We went from, when this whole U.S. exceptionalism trade started, I remember 2011. Okay, so two of the five most expensive cities in the world were in Japan. Two were in Australia. Australian dollar was super expensive, and the yen was at like 80 or something, right? Well, and by the way, the U.S. dollar was on its butt, and the S&P was like 1,100 or something like that. Let's fast forward here to mid-August 2025. Well, now the S&P is 6,500. The dollar's, even though it's down some, it's very strong, and the yen is like 150, right? It's just shade under 150. So yeah, I think you want to think about that. I do like Japan in general. I think there's interesting stocks there. And as I said at the beginning of the show, I mean, I got back involved in the BABA in the last month, and then added more yesterday. I'm trying to get involved with the ByteDance on the private side. Last year I was involved with BYD and Xiaomi. They were industrial guys. I don't really like them as much. They have an excess capacity situation. And go back to what I said about Goodyear Tire. I'm out on industrials. Like I'm not I have no interest in industrials anywhere right now. So yes, maybe in Japan, if they can sell domestically and then they have energy, like an energy intensity to it. Now that could be somewhat interesting but you got to really do some work on industrials. That's like my takeaway, is like, stick with the rocket mortgages and the internet and the,
yeah. What was that saying our friend Larry Peck said once on the show? He said, sometimes the next Microsoft is Microsoft.
Yeah.
Yeah, and actually, that's one of the things I came to the conclusion is like maybe the best thing to do if I'm really interested in this is just to buy FXY, which is the Japanese yen ETF, if I really just want that exposure. And the other part of, do you really want to be up at, and you've talked about this, Ben, of being up at all hours of the night, companies reporting, you have exposure, and if it's a small enough position that you're not going to do that, then you can get cut by 1,000, death by 1,000 cuts of just not watching them. Right. And if it's big enough, guess what? You're going to be really tired, and I frankly don't want to work that hard. So.
Exactly.
Yeah, I mean, like, I'm in California, or Steve is. It's a little bit easier to do Asia over here. It's tough in New York. In New York, those are weird hours. Like they're getting up, and it's like 8, 9 p.m. You're like, all right, let me grab a coffee before I go to bed. You know what I mean?
Yeah.
Like, not a great lifestyle choice, I would imagine. But yeah, I don't know. I mean, Tencent. I don't know if you guys saw Tencent had a really monster print last night, and that's one of the reasons why BABA is up 3 or 4% today. And so I think it's the right idea, David. I think it comes back to what we're saying is that what I was saying before, right? You got to feed the beast. It's going to go wherever there's value and there's yield and there's risk premium. And if the U.S. is in this position where multiples are high, I mean, chasing what's been working for a while and what everyone owns, you need new buyers, basically. Like, if you think about how markets work, now, if you want to just own the asset forever, that's different. But like a lot of stocks you want to be there right before new buyers come in and lift it up, right? And so maybe China's there, maybe there'll be some money for Japan. But yeah, I mean, I would much rather be in China and Japan than Europe. I can't hate Europe and European stocks enough, or express my hate for them.
Okay.
So I like it, David. I'm with you. I endorse. And FXY is a fine product, like currency hedge.
Yep. Lots of liquidity.
Yeah. I mean,
no,
if you want
low vol
in the weeds, there's probably a lot of interesting stuff, but it just, again, how much work do you want to do?
Yep. All right, boys. We've been at this for 44 minutes. I think that's enough. Let's give everybody their Wednesday back. Thanks for joining us on Wall Street Beats. I'm Steve Lamar. That was David Maris and Mr. Benjamin Bry, and we will see you tomorrow. Follow us on wallstreetbeats.com and passes.com/wallstreetbeats.
See ya.
See ya.